Welcome to the Deep Dive. Today we're tackling a really interesting accounting puzzle. Imagine a scenario where a company buys into a joint operation. Think of an oil and gas field, maybe, complete with wells, pipelines, processing facilities, the whole shebang.
Right. It's basically functioning as a business.
Exactly. It's a business, but it's owned and run collaboratively. Now, when someone buys a piece of that pie, how do they account for it? Is it like buying a slice of an existing company, triggering all the business combination rules?
Or is it just like acquiring some shared assets? That's the crux of it.
That's the core of what we're going to unpack for you today.
Exactly. And for you, our listener, who wants to get a handle on how businesses account for their activities, particularly when they team up on projects, this is a really illuminating area.
Yeah, it really shows how accounting standards try to keep pace with, well, the complexities of real-world business deals.
Definitely. We've sifted through a bunch of material for this, discussions from the IFRS Interpretations Committee, feedback from IFRAG on putting IFRS 11 into practice, and insights from firms like BDO and Deloitte.
And the standards themselves, I assume.
Oh, yeah. We'll also be looking at the official IFRS 11 standard itself, the thinking behind it, the basis for conclusions, and even some angles from the IFRS for SMEs.
Okay, let's unpack this, because it sounds like before some clear guidelines were established, there's a bit of a free-for-all in how companies were handling buying into these joint operations that were essentially businesses.
That's right. Before the specific updates to IFRS 11, especially in sectors like oil and gas, where buying and selling stakes and producing assets is quite common.
Yeah, happens all the time.
There were essentially two main ways companies were approaching this. The IFRS Interpretations Committee's papers really highlight this difference in practice.
So what were these two main ways of thinking?
Well, the first way was, in essence, to say, don't treat this like buying a business under IFRS 3. The logic here was that even if the joint operation ticks all the boxes of a business, it has inputs, processes, generates outputs, as defined in IFRS 3, the company buying the interest isn't getting control of the whole business.
Right, they only own a piece.
Exactly. They're only getting a share of it.
Yeah.
So they would account for it more like acquiring a collection of assets or maybe making an initial investment in a joint setup. And importantly, they wouldn't recognize any goodwill.
Okay, that kind of makes sense intuitively. You're not in charge of the whole operation, just a part of it.
Okay.
So what was the other way people were accounting for this?
The second approach is to say, no, wait, we should apply IFRS 3. The argument here was that the focus shouldn't be on control of the entire joint operations business. Instead, it should be on the interest that the buyer is acquiring. The buyer does control that specific share, right? And that share represents an interest in a business.
Oh, okay, so the share itself is the key.
Precisely. Therefore, it should be treated as a business combination, which means goodwill could potentially be recognized.
So, as you can imagine, this lack of consistent treatment, well, it must have made it incredibly difficult for you as an analyst or investor to compare companies.
Oh, absolutely. You'd see one company showing a large goodwill asset from buying into a field, while another wouldn't, even for, economically similar transactions. It made comparisons really challenging.
Yeah, apples and oranges.
Totally. And as the staff at the IASB pointed out, their view was actually that IFRS 11 already implied that IFRS 3 should be the go-to standard in these situations.
Okay, so what was the reasoning behind that? Why did they think the answer was already kind of embedded in the existing rules?
Their core argument was this. When a company involved in a joint operation acquires assets and liabilities as part of a business that the joint operation is running, then IFRS 3, which is specifically about how to account for acquired businesses, should naturally apply to that acquisition. They used a really helpful analogy, actually. Think about several airlines jointly owning an aircraft. Each airline accounts for their share of that aircraft as property, plant, and equipment under IAS 16, right? Even though none of them controls the entire aircraft.
Right. No single airline controls the whole plane.
Exactly. The fact that no single airline controls the whole plane doesn't change how each accounts for their piece of the asset.
I see the connection. So, by the same logic, the fact that a company doesn't control the entire business of a joint operation shouldn't stop them from applying IFRS 3.
To their acquired share of that business, exactly. If that share itself constitutes a business interest.
Got it.
Precisely. They also pointed to a specific part of IFRS 11, paragraph C7. This deals with reassessing assets and liabilities when companies transition from the older rules, IAS 31 to IFRS 11.
Right.
Specifically, if their interest in a joint operation shifts from being accounted for using the equity method to recognizing their share of assets and liabilities. This suggested a fresh look at the underlying assets and liabilities.
Which kind of lines up with IFRS 3 principles.
Exactly. It aligns with business combination accounting. And they even referenced IAS 8, the standard on accounting policies, which basically says if there's no specific rule for a situation, you should look to other similar IFRS standards for guidance.
So that pointed towards IFRS 3 again.
Yeah, it further supported the idea that IFRS 3 was relevant here. The IASB staff was essentially saying the principles were already there, just maybe not explicitly spelled out for this exact scenario.
It's interesting that even before the official amendments, the IASB staff felt the direction was clear. Were there any clues from how other major accounting systems dealt with this, like U.S. GAAP?
Yes, that's a good point. The IASB staff also looked at how things are done under U.S. GAAP. Specifically, they considered the AICPA audit and accounting guide for oil and gas producing activities.
Okay, and what did that say?
Well, this guidance generally says that acquiring a working interest in an oil and gas property that's already producing very similar to our example of buying into an existing oil field is considered a business combination.
So U.S. GAAP treated it as a business combination.
Generally, yes. And importantly, under U.S. GAAP, goodwill is typically recognized in these kinds of transactions.
Which aligns with that second IFRS view we discussed earlier.
Exactly, the one that said IFRS 3 should apply. So there was some international precedent for this approach. It wasn't like this idea came out of nowhere. Seeing how U.S. GAAP handled it reinforced the thinking.
So it sounds like there was a growing consensus, maybe even an existing one if you look closely, towards treating these acquisitions as business combinations. What did the IASB ultimately do to, well, remove the ambiguity and make it official in the IFRS standards?
Right. Well, to clear up this diversity in practice and make the application crystal clear, IFRS 11 was officially amended. This happened back in May 2014.
Okay.
And these amendments directly address how to account for those situations where a company acquires an interest in a joint operation, and the activity of that joint operation meets the IFRS 3 definition of a business.
And what's the core principle that came out of these amendments? What's the main takeaway?
The core principle is that the company making the acquisition should apply all of the principles of business combinations accounting found in IFRS 3.
Okay, the whole IFRS 3 playbook.
Well, yes, IFRS 3 and any other relevant IFRS standards that don't clash with IFRS 11. But, and this is key, they only do this to the extent of the share they've acquired.
Only for the piece they bought.
Exactly. And this isn't just for the initial purchase. It also applies if they increase their stake later on, provided they still maintain joint control.
Right.
One interesting point to note is about previously held interests. If they already held an interest and then acquire more while still retaining joint control, or if they gain joint control over a joint operation that's a business, they don't go back and remeasure their previously held interest at fair value.
Okay, so no remeasurement of the old stake if you keep joint control. That simplifies things a bit.
It does. So it's like a scaled-down application of IFRS 3, focused specifically on the acquired portion.
And it's crucial to remember, you mentioned this, that this only kicks in if the joint operations activities actually meet the definition of a business under IFRS 3.
Absolutely critical distinction. If you're just buying into some assets that don't constitute a business, then this specific guidance doesn't apply. You'd follow the existing IFRS rules for asset acquisitions.
Okay. And were there any new disclosure requirements tied to this?
Yes. As part of these amendments, there's also a requirement to disclose information, just like you would for a regular business combination under IFRS 3, but obviously tailored to this specific type of acquisition in a joint operation.
Right. Makes sense.
Yeah.
This all seems like a pretty significant evolution in how these collaborative ventures are accounted for. But IFRS 11 itself, the standard that was amended, brought in some wider changes beyond just this specific acquisition issue, didn't it? It replaced the older standard, IAS 31.
That's right, yeah.
And I recall hearing about some fundamental shifts in how joint arrangements were viewed altogether.
You're absolutely right. IFRS 11 represented a more fundamental change by shifting the focus. It moved away from looking primarily at the legal structure of the joint arrangement.
Like whether it was in a separate company or not.
Exactly. And it shifted the focus towards the rights and obligations of the parties involved. That became the determining factor.
Okay, so substance over form, essentially.
Very much so. And it introduced the two main categories we touched on earlier: joint operations, where the participants have direct rights to the assets and are directly obligated for the
Like
liabilities.
our oil field example, potentially.
Potentially,
Yeah.
yes. And joint ventures, where the participants have rights only to the net assets of the arrangement, usually meaning it's housed in a separate legal entity.
And one of the major practical changes resulting from this was getting rid of something called proportionate consolidation, right, for jointly controlled entities.
Yes, that was a really key change. Under the old rules, IAS 31, companies with certain jointly controlled entities often had the option to use proportionate consolidation.
And remind us what that involved.
Yeah, sure. Under proportionate consolidation, a company would basically report its share of each individual asset, liability, income, and expense of the jointly controlled entity directly on its own financial statements, line by line.
Uh, okay. Merging its share in.
Pretty much. IFRS 11 eliminated that option entirely. No, these arrangements have to be classified as either joint operations or joint ventures.
And the accounting follows that classification.
Precisely. For joint operations, you recognize your share of the assets, liabilities, revenues, and expenses. For joint ventures, you generally have to use the equity method of accounting.
It sounds like figuring out whether an arrangement is a joint operation or a joint venture now requires a lot more careful consideration then. You have to look beyond just the legal wrapper.
Absolutely. It requires a detailed analysis of the legal form, yes, but also the specific terms outlined in the contractual agreements and any other relevant facts and circumstances. It's not always straightforward.
And interestingly, you could have something in a separate company that's still a joint operation.
Yes, that's possible. Even arrangements structured through a separate legal entity can still be classified as joint operations if the contractual terms give the participating parties direct rights to the assets and direct obligations for the liabilities held within that entity. Again, it really emphasizes that substance over form principle.
And I vaguely remember something about venture capital firms having a different way to account for their investments in joint ventures. Is that right?
That's correct. There's a specific exemption. Venture capital organizations, as well as mutual funds, unit trusts, and similar entities, have an option under IFRS 9, that's the financial instrument standard, to measure their investments in joint ventures at fair value through profit or loss.
Instead of the equity method.
Right, instead of having to use the equity method. This was actually carried over from a similar allowance in the old IAS 31, and it recognizes the unique nature of their investment activities. For them, fair value is often seen as the most relevant measure of performance.
Okay, interesting exception. So, with all these significant changes coming in with IFRS 11, including the specific amendment for acquisitions we focused on, how did companies actually transition to these new rules? Were there specific steps they had to take?
Yes, there were quite detailed transition requirements for companies moving from IAS 31 to IFRS 11. It depended on how they previously accounted for their interests.
Okay, so for instance, if a company had used proportionate consolidation for something that was now classified as a joint venture under IFRS 11.
Right. In that scenario where they previously used proportionate consolidation and now had to switch to the equity method for a joint venture, they generally didn't restate prior periods.
Ah, okay,
Oh.
so no full retrospective application.
No. Instead, at the beginning of the earliest period presented in their financial statements when they adopted IFRS 11, they recognized their investment in the joint venture. The initial amount was essentially the sum, the aggregate of the carrying amounts of the assets and liabilities they had previously proportionately consolidated.
Including any goodwill.
Yes, including any goodwill that might have already been recorded as part of that proportionate consolidation.
And what about the flip side? If they were using the equity method under IAS 31 for something that was now classified as a joint operation under IFRS 11.
Good question. In that case, at the start of the earliest period presented, the company would basically de-recognize the investment they had previously accounted for under the equity method.
Get rid of the single investment line item.
Exactly. And instead, they would recognize their individual share of each of the assets and liabilities related to their interest in the now classified joint operation. This also included reallocating any goodwill that might have been part of the carrying amount of that previous equity method investment.
Okay. Any tricky bits with taxes during transition?
Well, one important point the transition guidance specifically highlighted was that the initial recognition exception in IAS 12, the income tax standard, did not apply during these transitions. Meaning, companies had to consider and recognize any deferred tax implications arising from these adjustments right from the start of the transition. They couldn't just ignore the tax effects initially.
Okay, got it. And the specific amendments we discussed earlier, the ones about buying into joint operations that are businesses, did those have their own timeline for when companies had to start applying them?
Yes, they did. Those specific amendments dealing with applying IFRS 3 principles were required to be applied prospectively,
Prospectively meaning.
meaning they applied only to transactions occurring in annual periods beginning on or after January 1st, 2016. Companies didn't have to go back and restate acquisitions that happened before that date under the new rules.
Although they could adopt early.
Yes, early application was permitted, but the default was prospective from 2016 onwards. This prospective application made sense, really, trying to apply these rules retrospectively.
Listen, a nightmare.
Pretty much. It might have involved significant challenges like trying to determine fair values from years ago and performing impairment tests with the benefit of hindsight, which is always difficult.
Yeah, okay. Finally, let's briefly touch on the IFRS for SMEs, the simplified standard for smaller companies. Was there any thought given to aligning that standard with all these changes in the full IFRS 11?
There were definitely discussions about it within the SME Implementation Group, or SMANG, the group responsible for the IFRS for SMEs. They looked at whether to align the SME standard with IFRS 11.
And what was the conclusion?
Well, while there was an initial question about alignment, the SMANG raised some practical concerns. A major one was the cost-benefit balance. They felt that the added complexity of some of the IFRS 11 requirements, like the detailed analysis for classification, might impose costs on SMEs that wouldn't necessarily be outweighed by the benefits, especially for companies with simpler business structures.
Right, keep it simple for SMEs.
That's the general idea. They also highlighted that the IFRS for SMEs already offers a choice in Section 15 for accounting for jointly controlled entities. SMEs can choose between the cost model, the equity model, or the fair value model for these investments.
Which is different from full IFRS 11.
Yes, it's different from the mandatory equity method for joint ventures under full IFRS, unless that fair value option for VCs applies. So there was already a divergence there.
So what did they recommend?
Ultimately, the staff recommendation was to primarily focus on seeking views on aligning the definitions of joint arrangements, joint operation, and joint venture in the SME standard with those in IFRS 11, but maybe not a full alignment of all the detailed accounting treatments.
Okay, focus on the basic definitions for consistency.
Pretty much, yeah.
So to bring it all together then, the key takeaway here, the main point from all this, is that when a company acquires a stake in a joint operation that is essentially functioning as a business.
Take our oil field example.
Right. They need to account for that acquisition by applying the principles of IFRS 3 business combinations, but only to their share of that business.
Exactly. And this move aims to create more consistency in financial reporting, which we saw was lacking before, especially in how goodwill is recognized. And the goal is to provide a more accurate and economically relevant picture of these collaborative business ventures.
Yeah. And for you, our listener, understanding this nuance is really important when you're analyzing the financial statements of companies involved in joint projects. You see these a lot, especially in industries like oil and gas, resources, infrastructure.
Absolutely. Where these arrangements are so prevalent, it really highlights how accounting standards are continually being refined, trying to better reflect the underlying economic reality of business transactions, even when they get pretty complex.
Definitely. So here's maybe a final thought for you to chew on. The shift we saw discussed here, from IAS 31 to IFRS 11, with its emphasis on the underlying rights and obligations rather than just the legal structure.
That substance over form idea again.
Exactly. It feels like part of a broader trend in accounting, doesn't it? Towards a more substance over form approach. It makes you wonder, in what other areas of accounting might we see, or should we see, similar fundamental shifts in perspective in the future?
That's a great question. Where else is the legal form, perhaps, masking the economic substance?
Yeah, definitely something to keep in mind as you continue to navigate the sometimes complex world of financial reporting. Thanks for diving deep with us today.